This is the Bloomberg Surveillance Podcast. I'm Lisa Abramowicz, along with Tom Keene and Jon Ferro. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us now, Geoff Yu, Senior Market Strategist at BNY Mellon. To kick off the programme with us, Geoff, great to have you with us, sir. Your reaction, I guess, first of all, to what we saw from the BOJ. What is the new line in the sand for a Japanese 10-year government bond yield?
Well, if you look at that slide that the BOJ announced, there's this hazy part between 0.5 and 1%, right? So I think that's the BOJ telling you there is no actual line in the sand. Strategic ambiguity, I guess, there's some component to that. But taking a step back, if it's tightening and financial conditions that you're trying to achieve, then generating volatility in FX markets, which Governor Ueda talked about, and in fixed income markets, then job done. Every BOJ meeting is probably going to be live up ahead, and that marks a change compared to the previous decade.
So, Geoff, you actually believe that maybe this opens the door to taking a step towards raising interest rates next year?
I think everything is on the table. So Governor Ueda himself admitted, April, the outlook, and perhaps a bit too much on the benign side. And there's a 70 basis point increase in this year's inflation outlook, hence a tweak. Now, you cannot phrase or you cannot really characterize such a tweak in response to a higher inflation print or inflation forecast as an easing step, right? So I think the market can see that. But again, it's about the next step. We know the trajectory is towards tightening in comprehensive conditions, the phrase that they're using, and markets, yen, equity markets, and in particular, JGB's global fixed income will need to react accordingly.
Has the reaction in global markets, we did see a sell-off in sovereign developed market bonds. We also saw a sell-off in risk assets. Is that indicative of what could potentially happen, that it will be orderly, but it will be disruptive? Or do we not have any sense at all of what the response will be to true yield curve control abandonment, given that we've just heard whispers and unclear guidance?
All of the above, really. But what we do know is, those figures that you mentioned earlier, so US 10 years, moving much more than what the JGB has done. 1 basis point in the US in bonds is not equivalent to 1 basis point in JGB 10 years. Let's make that clear. So the more that it's going to move, then if you assume the process is going to be linear, then the stronger the reaction is going to be. Having said that, Japanese investors, they've been retreating from Europe for some time now. They've been retreating from the US on a relative basis. China's been retreating as well. So looking for new purchasers, for the Eurozone bond market, for the US Treasury market, I think that has been going on for some time now. So in that context, shouldn't generate too much volatility if Japan steps back a bit more.
Okay, so in other words, even if we do get full normalization, you could see it happen in an orderly fashion that won't necessarily present a tail risk or some sort of headwind to sovereign bonds globally.
I think as long as the normalization itself from Japan, from Tokyo, is going to be more orderly, then the answer is yes. If it's going to be sudden, stepwise changes, large, discrete changes of 25, 50 basis points, something like that, then it's a different story. So it takes two to tango.
We have to go beyond wrapping up the last 24 hours. We've got to wrap up the last 12 months. For the last decade, we've had two anchors around the neck of the global bond market. The ECB, the BOJ, buying government bond yields, seeing what's been happening in Germany for a long, long time, Geoff. Those anchors are away, slowly being lifted over in Japan. So I need to think about a new floor in the global bond market when it comes to yields, Geoff. How are you thinking about that now?
Well, two things there. Firstly, you said the word yourself. It's going to be slowly lifted, right? So they'll make sure that it's not going to be a volatile process, as excess reserves, that aspect of the central bank's balance sheets and continues to come off. They'll be monitoring that very, very quickly. But the second part of it is going to be data. And here I think the impetus is more on the ECB or anything. Imagine previous environments. If we had German manufacturing PMIs, on the 30 handle, the ECB would be talking about easing, right? So now that's where the direction of travel is. So I think we have to think about, who's going to stop this balance sheet unwind process. And I think that will help to serve as an offset. But overall, at this point, looking at all the central banks, I think that markets can absorb this for now.
Well, but Geoff, just to push us a little further, as we look here, question whether we're seeing the end of the rate hiking cycles for both the Fed and the ECB, which some people believe is the case. We're talking about the potential abandonment of yield curve control. Where are we going to head if yields do come down? What is, to Jon's point, the floor that we hit that seems like the new normal at a time when some of the more unconventional policies are no longer in effect?
Well, if you really want a nominal number, my rule of thumb is always, where is potential growth on a nominal basis? So in the US, is it on the 4 handle, 5 handle? In the Eurozone, if growth is going to be close to flat, your inflation target 2%, is it on the in the 2 to 3 range? Japan probably slightly lower. So that's where longer term, the Wixelian rate, so to speak, that really starts to come in. But to get there, we need to get inflation back to target first. And I think that is the risk. That means a lot more unwinding, more QT first before we can even start that discussion.
Let's get to favorite trades in FX right now, Geoff. Which one?
So you want to own APAC funders against the dollar right now. So what I mean by that, your Korean wons, your Taiwan dollars, even renminbi in the short term in this respect, right? Because now that Japan has moved and the yen can strengthen a bit, then that gives more room for Asian central banks to tighten things or at least shift towards a more assertive stance. Because you have China, Japan put together, the yen renminbi 40% in your trade weighted basket. You can't afford to let your currency strengthen. Now they are allowing a bit more tolerance for strength. So can you. And given in our iFlow data, our custodial positioning data, these currencies are quite underheld right now. Good risk reward to start buying them back.
Geoff, just to be clear, that's APAC versus the US dollar?
Yes, and euros and versus G10 as well.
Okay. Geoff, wonderful to catch up. As always, buddy. Geoff Yu there of BNY Mellon, wrapping up the central banking trilogy this week.
We have with us someone who has been at the Fed who might tell us about happy hour after getting good economic reads. Jonathan Pingle, Chief US Economist at UBS, who is not at happy hour currently, sitting at his office. I'm curious from your vantage point, Jonathan, how much conviction you can have in this soft landing narrative when we keep getting data print after data print showing, disinflation, robust growth, this feeling that maybe we will just immaculately get price stability.
Yeah, I mean, this is certainly good news, but we're still actually a long way from price stability. I mean, I think, looking at today's employment cost index data, as sort of Mike was saying, as well as the core PC deflator, the year-over-year change falling to 4.1% puts the Fed actually within striking distance, 0.2 of their sort of full year projection for later this year. But even at 4% or the Fed's 3.9 in Q4, you're still a ways away from what you would call price stability. So everything looks great now. I mean, looking at, Mike was mentioning real spending coming in a little stronger. We'd actually sort of expected the 0.4 increase, and he's right. I mean, we ended up revising up our Q3 consumption estimates after retail sales as a result. So this is all good news, and the economy has certainly proved resilient, but they do have this problem that we're making progress on inflation, it looks like, but we're not actually at 2 yet. And there's actually a pretty big gap between now and how we're going to get there, and a lot of uncertainty. But, at the moment, Lisa, yeah, the data looks good.
What's the bigger risk right now? That we're wrong about inflation just steadily coming down and we see a reignition of some of the price increases, or that the economy slows down more dramatically and that the strength that we've seen recently perhaps isn't indicative of the longer term trend?
Well, I am pretty worried that this economy is going to slow meaningfully in the coming quarters. There are a lot of positives right now, but there are also headwinds. And I still kind of agree with Chair Powell that there's still follow through from the monetary policy tightening. I think there's still excess savings that's percolating through and supporting spending. And some of these forces could diminish. We also have things like student loan repayments coming up. I mean, there's a number of headwinds and challenges that we're still going to have to face as an economy. But I think you've nailed the sort of risks on the head, right? Because everybody, of course, would like to have a soft landing and not have job loss and have this continue. But the initial conditions are a little tough. And by initial conditions, I mean, we're starting with a low unemployment rate. Even with the ECI at 1%, I mean, I think that's going to be great news at the Fed. Take a little bit of the wind out of the sails of the more work to do component of the committee, but that's still a little over. It's 4% annualized, and the Fed kind of needs it to get it down closer to 3.5. So you got a low unemployment rate, nominal wage inflation that's still a little brisk. if the economy stays strong, there is the risk that the Fed might have to hike more and do more work to get the slowing that they need in the economy.
A lot of people, Jonathan, have been talking about how it's been easier to get a disinflationary trend just simply on the year-over-year comparison numbers, at least over the past few months. What changes? What areas of the inflation overview are you looking at? Is it housing? Is it car prices? Is it something else that could fuel some sort of strengthening in the inflation reads?
Well, I mean, it's all of that. I mean, I don't think the details of the inflation data in my career have ever been as looked at as they are today because of how crucial it's been for monetary policy. But when we think about, sort of what's unfolding in the various chunks of the basket, I mean, I think, there's people have talked about, super core and sort of these measures. I mean, I don't want to put a label on it, but when we look at some of the services components that are most linked to wage inflation, many of them also have relatively persistent components. I think we can get comfortable with the goods disinflation and we can see it. And I think, we're watching sort of, OER and rents slow and the CPI data. But, these other services, are really sort of what I think is worth watching for where the improvement could come, or what might reaccelerate because of the low unemployment rate. And that's one of the reasons I think, Chair Powell in his press conference, went ahead and mentioned the ECI as sort of one important data point they would get between the July and September FOMC meetings.
And if you're just joining us now, we did see the ECI, the Employment Cost Index, come in at 1% for the second quarter. The expectation had been 1.1%. It was down from 1.2%. Personal spending coming in stronger than expected at 0.5%. Personal income coming in softer, so people making less and spending more. Michael McKee, you've been digging under the numbers. What do you see?
Yeah, let's look under the hood. A couple of things that Jonathan was talking about. The ECI for wages goes down to a 1% gain from a 1.2% gain in the first quarter. And that would be considered reasonably good news. But then when you look under the personal income figures, wages went up 0.6% in the month of June. And that is up from 0.5%. It is actually the highest increase since January. So we have two sort of contrasting views of what wage pressures are doing at the moment. And John mentioned, as we do every time we get an inflation figure, the super core, which is Jay Powell's favorite thing. Core services ex housing comes in at a 0.2 gain, 0.22 if you want to round it out to three figures. And that puts it at a 4.1% increase for the year, which is going to be your lowest since basically last August. So things moving in the super core direction, take out housing out of the equation, and services for the PCE, like the CPI, are down. But the wage numbers still healthy, and that suggests consumers can still keep spending. The question is, will the Fed see that as inflationary?
Jonathan, as we talk about these numbers, 4.1%, down significantly from what it had been, from 4.6% the previous reading. When's it enough? Are we heading back toward 2%? Or, to the conversation we had with Richard Clarida, are we looking at a 2.5% or something somewhat above the target that the Fed's just going to live with?
Well, I mean, this is a question they're going to have to answer at some point, I think, next year. At the moment, obviously the 4.1 is not enough. I do think it's pretty relevant, though, for sort of the meeting by meeting decisions they're going to make going forward. At 4.1%, they're only 0.2 percentage points away from their full year core inflation projection already in the June data. So they're clearly making some progress. The other thing they're making progress on is real rates. This is going to widen the gap between the funds rate after the rate hike on Wednesday to a level, that hasn't been around since 2007. So they're making progress in terms of restrictiveness, not just because of the rate hikes now, but also because they're making progress on inflation. Now, a year from now, let's say inflation is moving down to 2.5%, they're going to have to make a decision about how hard they push to get it back down to 2.0. I do think that monetary policymakers would like to actually get it back 2.0 for their credibility, to show that they can do it? Are they going to really work very hard to run it at 1.8 so that they can show that they're on both sides? I don't know that that's worth really costing a lot of people their jobs, but I do think they're going to leave, if they're struggling to get back to their target, I think they probably would leave restrictive policy in place for a while.
Jonathan Pingle of UBS, thank you so much for taking the time.
Jane Foley of Rabobank saying this, that the BOJ tweaked YCC in, quote, a very cautious way. As expected, the BOJ raised its 2023 inflation forecast, but there was no upward revision to core CPI in 24 or 25. Therein lies the reason for continued caution from the Bank of Japan. If further progress is made in reviving domestically driven inflation, the BOJ will act again, but they are clearly in no rush. So, Jane, we've got to start with that question. Lisa's asked it a few times, and Danny Berger asked it again this morning. And Jane, thanks for being with us. Is this the starting gun on tightening, or just setting up policy to keep things a little bit more sustainable and easier for longer?
The starting gun really reminds me of the tortoise and the hare, and I think the Bank of Japan really is the tortoise in this race. It is going to be in no rush. And this is, backing away from yield curve control, because it can be a nuisance sort of policy. It can push policymakers into corners. And we had this in December when the Bank of Japan, made an adjustment to the range for the 10-year yield and said it was an adjustment. Now, clearly, we can see those distortions. You have the possibility where you have maybe 5-year yields, 7-year yields rising above the 10-year yield. That's not what they want to signal, so they had to raise the parameters, and really I think there's something about what's happened today which is the same. They want to take themselves away from being pushed into a corner by market conditions and hence the loosening. But on the other hand, if you read through a lot of the rhetoric from some of the Bank of Japan policymakers, some of them are clearly seeing these signs that inflation conditions are just beginning to normalize. And I would say perhaps the real piece of juicy news from Japan, this week, is that the government looks likely to be recommending another hike in the minimum wages. That would be a 4% hike. There was already, a really big rise this year. So if that 4% goes through, that is your wheels in motion of domestically generated inflation. That's what they want to see. That's the sort of news that we really ought to be reacting to.
So, Jane, that long-term forecast for inflation that comes from the Bank of Japan, should I view that as an honest view on where they think inflation will be, or just a signal to the market for where they want the market to believe policy will be?
Well, the government came out with a pretty similar forecast for core CPI. I think it was 1.5% for the next fiscal year, stripping out, some of the base effects because there have been some energy-related subsidies, for instance. So again, the government, the Bank of Japan, lots of economists are on the same page here. They think inflation next year will be lower than this year. And that is why they've got to be cautious, because we've got to remember a lot of the inflation that we are seeing, people are saying, Bank of Japan or Japanese inflation on the headline is firmer than in the US. Maybe they should be tightening, but that is really misleading, because a lot of the inflation in that particular print is imported prices. Now, imported prices are not domestically driven. That's what they want to see. It's the opposite, really, to Europe, to the Bank of England, to the US. They want to see this wage price spiral, getting themselves up to sustained inflation around about 2%. We're on that road, but they're not quite there yet.
Is it a coincidence, Jane, that the Bank of Japan's tweak, I should say, comes after a real shift from both the Fed and the ECB moving away from forward guidance and away from committing to further rate hikes?
Well, I think the moving away from forward guidance sort of reflects the fact that the committees within those central banks are perhaps, there's bigger gaps between the doves and the hawks, because if everyone was on the same page, it's obviously easier to give forward guidance. But when you have this more diverse range of opinions, you can't really do that. And I think that's probably true of the Bank of Japan as well. I think there is a range of opinions within the Bank of Japan. If you read through some of their rhetoric, some of those policymakers are perhaps more ready to act on policy than others. others. But, a caution has always prevailed through the Bank of Japan because of its history with deflation and disinflation. And I think that is still here. And I think that's very evident in the commentary this morning from the Bank of Japan governor.
It hasn't just been the Bank of Japan that's been causing some waves. This week, there seems to be a feeling that both the Fed and the ECB may be done with rate hikes, which calls into question whether the ECB actually will end up hiking further than the Fed this year, which was the consensus heading into 2023. What's your view on this? Do we have to rethink this, that maybe both are at their peak and their rate hiking cycle over in Europe isn't going to be as long as many people thought it might be?
Yeah, we're coming down on the view that they may pause in September, that there may not be any more moves from the ECB. Some of the commentary from some of the officials from the ECB in the last couple of weeks, has been mixed. But there have been some comments indicating that perhaps core inflation could be plateauing, because obviously that's the focus for Europe, this core inflation, this stickiness there. But if we look at some of the economic data, for instance, those PMIs that we had for Europe at the start of the week, they were really quite worrying. If we saw, the credit survey from the ECB too this week, well, that showed that the higher interest rates are clearly impacting. So there are, recession is hanging above Europe. Germany, of course, already in recession. Recession risks are really very real, and that may give the ECB cause for constraint in September and pause policy. So we are data dependent. We have to make up, our minds on that according to the data. But there is certainly a risk that the market is going into the possibility of a pause in September whilst it's long the euro. And that's really important, because I think positioning here is going to be adjusted. And I think the market has got very long the euro and anticipated with a very high hawkish ECB. And that might have been, overdone.
All favourite trades. Let's wrap up. Jane, downside on the euro. What is it?
Well, we've had, for a while now, a 3-month forecast for euro-dollar at 108. A few weeks ago, I think people, wouldn't have agreed with that. I think now maybe people are coming round to that. The market is very long the euro, and I think it's increasingly difficult to see that situation being justified.
Jane, thank you for getting on board with the programme this morning, following that breaking news from the Bank of Japan. Appreciate it. Jane Foley of Rabobank responding to the latest headlines out of the BOJ. Steve Chiavarone joins us now, Head of Multi-Asset Solutions at Federated Hermes. Steve, wonderful to catch up with you. You mentioned the pain trade in this equity market may well be a higher equity market. Just walk us through it, Steve.
Yeah, I mean, it's been the thesis that we started with in January when we went back overweight, which was that, look, even if recession risks do materialize at some point, and that's still an open question, it's not today, and tomorrow doesn't look good, John. I mean, you look out, if you're still in a position of tight labor markets, inflation that's sticky, a Fed that, at best is maybe pausing, may still be in the hike cycle. We'll see what September and November bring, but is certainly not anywhere near, a place where they're cutting. Historically, that's not an environment where you have big equity sell-offs. If you look, Fed pauses are really good for equity markets. 15% returns on average, 20% max rallies, drawdowns that are relatively small. And so I think that you're in this scenario, and I heard you mention in the prior segment this idea of a kind of summer window. I don't think it's a summer window. I think this goes higher for longer, and I'm talking about equity markets right now. So we see upside through the old highs, even if storm clouds do eventually, materialize, but we don't think it's soon.
So, Steve, upside where? Because people are willing, or at least want to shift away from the tech winners. They want to think about maybe the things that are left behind, cyclicals, banks, energy, take your pick. Steve, how are you thinking about that?
Yeah, so again, if you look at both Fed pauses and then even once you get into Fed cuts, cyclicals tend to do better than your kind of defensive growth names. Also, a 27 times multiple for the Russell 1000 value. That's hard for us to kind of just hold our nose and buy. So what we're buying is everything else, pretty much. So we've been overweight value, particularly cyclicals and the defensive dividend payers, a little bit as a hedge. And then our newest buying has been in small cap growth. The idea is that it entered its sell-off a year before. Those names are still down 20% on a 2-year basis. And while valuations look high on an absolute basis relative to where they were 2 years ago, we think they're attractive. So if there's any disruption to the kind of big tech and growth names. It's going to be those smaller companies we think that emerge. And we just think that offers a much better kind of upside scenario. So it's really cyclicals. Yes, a little bit of those defensive dividend payers, but then also the small cap growth, where we think there's some better opportunities.
I want to point to something that Torsten Slok wrote that John was talking about earlier of Apollo, where he wrote, for markets to continue to trade higher, the soft landing must be a soft landing, not a reacceleration. And he's speaking, of course, about inflation. How much does your bullish call hinge on inflation not reaccelerating and continuing to go down?
Yeah, so, in the list of things that you need to watch, I'd put that in there. You've gotten the housing market. And home prices have shown some signs of reacceleration. I know we've all seen some of the labor deals that have come through. We're watching wages. Our expectation is that you will see some reacceleration in at least a headline number in the back half of the year. That's just math, Lisa. I mean, your toughest comps or your easiest comps, depending on how you want to think about it, were really in the first half of last year. As you get to the back half, just the base effect should take you up. So we still have a 3.9% core CPI forecast for this year. If it was materially higher than that, and we're talking about a Fed then that is forced into, much more aggressive policy action, again, that could have some disruption. But if you look, there has never been a market in the last 40 years, an S&P 500, that was negative during the hike cycle. There was never a market except for one that was negative during the pause cycle. And so it really is, once that economic data has deteriorated and you're in a cut cycle, that you start to worry about those big downsides. But it's hard to see us in that scenario in 23. And that's the story, that if you're a soft landing person, or you're someone who sees a kind of new bullish trend here, being overweight equities obviously makes sense. Even if you're someone that's cautious, though, the historical track record suggests that for some time, and not a very short period of time, you probably still have upside risk, at least through the old highs.
When do you know it's gone, Steve, the upside risk or the upside potential for some of the risk assets?
Yeah, I think what you watch and what we're watching are going to be spreads. Spreads are one. When you start to see spreads move up, I think you need to see a little bit more deterioration in initial jobless claims. You've got to at least get to that 300,000 level before you can start to really think about a material deceleration in the labor force. The unemployment rate would need to kind of creep up on the back of that. The yield curve, not just being inverted, but starting to re-steepen would be a sign. If you start seeing that yield curve get back towards zero, historically, that's a sign that that's starting to happen. Bond yields that are falling. You get the theme here. Those are all the things that I think the most bearish folks thought would be happening already. And granted, even though we saw a first half rally, I might have expected to see more progress in that direction so far this year, but it hasn't happened. And so until it does, you've got to stick with the regime that you're in.
Stick with it. Steve, that's the message. Thank you, sir. Steve Chiavarone of Federated Hermes on this sweet spot in the market that he thinks can last a whole lot longer than many others do. I've got favourite guests. Here's one now. Jay Pelosky, Principal and Founder of TPW Advisory. Jay, it's good to catch up, buddy, as always. Can we start in Japan, just briefly? The latest change from the BOJ. I know it's an equity market, Jay, you've been looking at more closely. Did you like what you heard this morning?
Yes, I think Japan has had success at something that they've been fighting for 40 years, John, right? Which is to get rid of deflation. And they've done that. They now have inflation. And so we like Japan as an equity market. It's set up beautifully. The currency is super cheap on an OECD purchasing power parity basis, 50% undervalued. Stocks are super cheap, right? You have stocks that sell for less than cash. I think 20% of TopX sells for less than the cash that's on the balance sheet. We like Japan a lot. We think the BOJ is exiting yield curve control. That's going to set off not only a potential allocation out of foreign assets, which is what Japan institutions have been doing for years, back into domestic assets, but also within the domestic asset allocation, where the famous Mrs. Watanabe, the retail investor, has been doing nothing but buying bonds. Now bonds in Japan are going into the same bear market that U.S. bonds and European bonds have been in for the last, year and a half or so. And so that means a allocation shift to equities. And so Japan is, we think, one of the most attractive markets in the world at this present moment, looking out on a 6 to 12 month basis.
Jay, just to build on that, yesterday evening I was going through some decks, some slides from Apollo's Torsten Slok on Japanese banks and looking at net interest margins. It was shocking to see just how narrow those net interest margins are at a Japanese bank compared to, say, a Wells Fargo, which is at a multiple of that. Jay, would you play it through the Japanese banks, and how much of a move have we already seen anticipating what we got this morning?
Yeah, the banks have moved first, obviously, because as rates go up, that issue that you spoke of gets helped out, as we've seen with U.S. banks, right? We've been in this extreme low rate environment. And one of our key conclusions, Lisa was talking about strategic ambiguity, brought me back to my national security days studying for a master down in D.C. But they're looking to do something different. And the opportunity is to grow the economy and to have inflation come back. And that helps the margins, that helps earnings. And just as we look at it in the U.S., right, high nominal growth, John, you remember we've been talking about this for ages, high nominal growth. The same thing applies in Japan, which is why you're going to have good earnings, you're going to have good bank results. And again, you're not paying anything for it. Less than cash, 20% of the market sells for less than the cash on the balance sheet. It's a value player's dream. It's a growth player's dream. The currency's going to appreciate. Rates are going up. Bonds are going to sell off. People are going to buy stocks. Really, I think it's a fantastic setup.
To be clear, it was Geoff Yu who coined strategic ambiguity. I was just parroting a perfect explanation of central banks this week. You say a value player's dream over in Japan. What about in Europe, which you have been overweight? Is there still a value player's dream in an area that has disappointed in a way that the U.S. has not?
Yeah, I mean, Europe has more of a challenge on the economic front, Lisa. I think that's pretty clear. But I think, again, the sentiment. Look, one of the things that we've been talking about is this tremendous gap between data and surveys, and sentiment. And the data continues to come in pretty good, and the surveys and sentiment continues to be, for the most part, pretty lousy. And data is winning out, and the same applies in Europe. You talk about banks, right? John knows this, and Lisa, we've talked about it over time. We've been a buyer and an owner of European financials for the last several years, and they continue to hit new highs. Just hit new highs in the last couple of weeks. So we think the situation in Europe is better than it's being portrayed. But to be clear, we were bullish Europe last year. We've been bullish Japan and Asia this year. We've talked about rotation. We wrote a piece called Rotation 2 months ago. That's been what's going on in the markets. We have a rolling rotation. So now looking forward, we're all about what's next, right? We want to look forward because markets are moving very, very fast. And so to us, what's next is we have clear skies. We have a manufacturing recovery. I think that's what's going to be the surprise in the second half of the year. Manufacturing is going to pick up as we restock the inventory drawdowns that have taken place. You're just talking about that on the oil side. One reason why we're bullish energy is exactly that thesis. And so we think the big opportunity right now for the next 6 to 12, 18 months is in emerging market equities and commodities, both of which are at 15 to 20-year lows relative to the U.S. equity market, as an example. So lots of upside in those two segments.
Do you need stimulus out of China to make that work, Jay?
No. We think China China's another, the poster child for negative sentiment. Just ridiculous about how negative people are about an economy that's a, massive, second biggest economy in the world that's growing at 5%, double the United States. It's growing at 5%, John, with pretty much an assurance. And they're making shifts, right? They're welcoming back the tech companies because they need them. So the whole issue around China tech is over. And one of the things we've talked about in the last couple of weeks, take some profits in U.S. big tech, reallocate back into China tech, things like K-Web, et cetera. We think emerging markets are going to lead the next cycle in central banks, which is rate cutting, right? We're at the end of the rate hiking cycle in the West, in the U.S. and Europe, maybe just beginning in Japan, fair enough. But emerging markets are going to lead the rate cutting cycle.
Yeah.
And we think markets like Brazil are very attractive. We like China. We like Brazil in particular within emerging markets right now. We like Japan. And then within the commodity space, we like energy. We like industrials. We like precious metals. Commodities, we think, are really the next thing. And they're breaking out. Again, within the last 2 weeks, WTI has broken out. Goldman Sachs Commodity Index has broken out. And that's telling you that we're not going to have a recession. So bonds priced out recession first by getting rid of the rate cut for next year. For this year, second half of this year. Then stocks with the move into cyclicals. And now commodities are pricing out recession. So you're not going to have a breakout in commodities in a recession, right? Those two things don't go together.
Jay, this would have been easier if we just started the interview by saying, what don't you like? You know, this would have lasted 30 seconds. Jay, it's good to hear from you. We've got to let you go.
He doesn't want
Jay
to
Pelosky.
go. He'll come back.
Let me tell you what I don't like you. We get along, don't worry.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Lisa Abramowicz, and this is Bloomberg.